Stocks fell off a cliff, the largest single-point drop in history.
Share prices continued to tumble in the aftermath of the Lehman collapse.
While Wall Street is in panic, one hedge fund decided to go big, committing billions of dollars to companies near bankruptcy. The owner of this hedge fund is Marc Lasry. Lasry was a special kind of investor. He invests when there's a blood on the street. 2008 was a perfect time for that.
With a bailout or without one, the big three automakers will also still have to lay off thousands of workers. They are back on Capitol Hill today, asking Congress for emergency funds.
But it became obvious to Lasry there is no way that a U.S. government will let the auto industry fail. Imagine the auto industry collapsed. The amount of people losing jobs would be unthinkable. It was just a matter of time when the Congress bails them out.
The overall amount and cost of financing the restructuring would be significantly higher in a Chapter 11 process than the working capital bridge that we're requesting here today.
Before the rest of the market realized that, Lasry zeroed in on a great investment opportunity. Ford, the nation's second largest automaker. They began buying $500 million of bank debt by Ford at a great discount to face value. Lasry was born in Marrakech, Morocco. Their parents left Morocco in 1966 and moved into a two-bedroom apartment in Hartford, Connecticut, where the 7-year-old Marc Lasry shared a bedroom with his two sisters.
My father wrote COBOL, so he was one of the first people to write computer code. My mother was a private school teacher, and my sisters and I went to the school where she taught.
Like many immigrant families in America, they know education is the only way out.
I got a great education. It was all because of my mom. I mean, there was a simple rule in our house: as long as you got A's, life was good. If you didn't, life was bad.
With the help of scholarships and loans, Marc Lasry attended Clark University in Worcester, Massachusetts. Lasry graduated in 1981 with a degree in history and was already enrolled to New York Law School. However, to pay for his tuition, Lasry had to take a job as a UPS driver.
You know, if you have a Jewish mom, you end up either being a lawyer or a doctor. I had gotten this great job working at UPS as a truck driver, and I remember I told my mother, I think I could make a career out of this. I think I could actually get into management, so I'm not going to go to law school. You know, my mother looked at me and said, look, you can do whatever you want, but it's not your life. So you're going to law school.
After law school, Lasry clerked for Edward Ryan, chief bankruptcy judge for the Southern District of New York. Going through all the filings and financials, Lasry became an expert on distressed companies and how to profit from them. He realized he was looking at a large and relatively untapped market with very little competition. When Ronald Reagan became the US president, he started a series of deregulation. As a result, the hedge fund industry boomed. The flexible structure allows them to take on all kinds of investments. I mean, there's so many types of hedge fund managers. There are the quants, there are the macro guys, event-driven shops, and short sellers. Lasry found out that it is highly profitable to invest in near-bankrupt companies. When a company is in financial distress, the market can be too pessimistic about a company's assets, creating an opportunity for investors like Lasry. There are funds, later known as vulture funds, that specialize purely in distressed debts. Unbeknownst to Lasry at the time, he was looking at an untapped market that will soon make him billions. Wasting no time, Lasry switched career from practicing law to the world of high finance.
Practiced law for about a year, and then I got out to go work at an investment firm that specialized in distress. It was R.D. Smith. So this guy, Randy Smith, I did that for about a year. I made him $25 million my first year. That's when $25 million was huge amounts of money.
In 1987, he landed a big position at Cowen and Company.
We ran Partners Capital. They gave us $25 million. We did about 60% a year for about 2 years.
It was right around the time his sister, Sonia Gardner, had graduated from law school, and Lasry's new department needed a lawyer. Soon Lasry and Sonia are making millions in just salaries and bonuses. They were doing so well for themselves, but they want to start their own firm. Even though they had made a few $1,000,000 for themselves, that's not nearly enough to start a fund. Instead, they want to start a brokerage firm that makes commissions from buying and selling debts on their clients' behalf. And after they accumulating enough profits, then they will form a portfolio. Their strategy is brilliant, and their lives are never the same. Lasry and Gardner opened their own boutique distressed brokerage firm in 1990 with $1 million of their own capital.
Thought, oh, it'd be great, manage your money. And we did really well. We sort of doubled the money every year for about 5 years.
By 1995, they became one of the biggest private distressed debt brokerage firms that existed at the time. By 1995, Lasry and Gardner formed their first Avenue Fund with less than $10 million. A small amount in the hedge fund world, but Lasry and Gardner know they could make more than 50% returns a year. Eventually, more investors will come. In the meantime, they start searching for deals. They know just where to look.
There was a company, Smith International, which was in California. It was in Newport Beach.
Smith International was an industrial equipment company that sold products to gas and oil companies.
Back then, people sort of viewed companies in bankruptcy, it's got no value. But in Smith International, you were getting paid somewhere around sort of, on the restructuring, 75 cents on the dollar. And you could buy those claims for anywhere between 10 to 50 cents on the dollar. So you just kept buying, and really you had to call individual creditors. I mean, there was no exchange, so you would contact individual creditors and you would negotiate with everybody and you'd buy claims one by one. And that's sort of how we made a lot of money back then.
Avenue Capital typically has about 40 to 50 positions at any one time. Generally, Lasry wants to have about 80% invested with 20% cash to take advantage of new opportunities. And surprisingly, they don't have any leverage to enhance their returns. Just as predicted, Avenue took off. In 5 years, it grew to $1 billion. In early 2000, the hedge fund was consistently making double-digit returns. Avenue did so well, Morgan Stanley bought a 15% stake in the firm for approximately $250 million. But just as they closed their deal, a gigantic economic storm has arrived. In early 90s, US was coming off from the Black Monday crash. A new industry is booming. A small group of hedge funds discovered that there were fortunes to be made by buying distressed debts. Lasry and Gardner grew up in a middle-class immigrant family. They became among the first to capitalize this thriving market, building their billion-dollar hedge fund in just a 10 years' time. But their investment strategy will be tested by the biggest economic recession since the Great Depression. In September 2008, the bankruptcy of the U.S. investment bank Lehman Brothers and the world's largest insurance company AIG triggered a financial recession, which cost the world tens of trillions of dollars, rendered millions of people unemployed, and doubled the national debt of the United States. Avenue Capital was already having a rough year, with about 25% down. But to Lasry, their losses on paper are just temporary. Once the market recovers, they will go right back to their original levels. Now is the time to play the offense. The financial crisis is making a lot of companies go bankrupt.
Back then, everybody thought all these companies were going into bankruptcy.
The most desperate of them all is Six Flags. Six Flags is an American company that runs dozens of theme parks. In 2004, Six Flags began to close and sell properties in an effort to help alleviate the company's growing debt. To make matters worse, On August 29, 2005, Six Flags New Orleans Park was severely damaged by Hurricane Katrina and has since been abandoned. It was all but inevitable. Six Flags was going bankrupt. Avenue aggressively started buying Six Flags bonds about 50% discounts to face value. Again, you have to think like a contrarian. Of course, it's a bad company, but the market is being too pessimistic about its assets, significantly undervaluing them. Avenue and his hedge fund friends joined the fire sale, acquiring $400 million worth of debt with just $200 million. By 2009, after Chapter 11 restructuring, they were handed over $480 million in cash. It's 240% return in 2 years. It can't get better than that. Lasry is a value investor who makes decisions based on intensive fundamental analysis.
What we're very good at is understanding value. So buying something at 60 cents or buying something at 50. I don't know if we're ever going to time the bottom, but we'll be very good at buying at pretty low prices.
But over the last decade, the distressed debt market has become more efficient, making it difficult to buy undervalued assets. But at the same time, there are more opportunities internationally.
More overseas right now, so huge opportunity in Europe. To be a really successful investor, you've got to constantly be buying when other people are selling. So I think to be a distressed investor, I think you just have to be able to weather those times.